So the first question you may have is, what exactly is fundamental stock analysis? So earlier, or the last module, we talked about technical stock analysis. Now, while technical stock analysis can be related to the personality of a stock, fundamental stock analysis is the health of the company. So think of the technicals of a stock as the personality, while the fundamentals are the overall health if you're thinking about a person. Now, fundamental stock analysis is the study of the financial health and fitness of a company. Now, the main factors analyzed in fundamental stock analysis are revenue, earnings, and debt. And the goal of fundamental analysis is to determine the intrinsic value of a stock. And we're going to define intrinsic value a little bit later on. I didn't want to confuse you guys with that yet, but we're going to revisit that. But in a nutshell, when we're looking at fundamental stock analysis, we're looking at the company revenue, what their earnings are, so what they're actually keeping of that revenue, and how much debt they have. And there are a number of financial documents that we're going to be analyzing that are really going to paint the picture of the financial health of this company, because it's very similar to your own personal financial health. You know, you can see somebody who is in poor financial health when they have too much debt, and there's also people who have a lot of cash and they don't have a lot of debt. That same thing holds true with companies. You'll find companies out there, some of them have a lot of debt, and some of them have very little debt, and they have a lot of cash. So essentially what you're doing is determining the health of that company financially and making sure they're in a good position to repay those obligations as well as grow in the future. Now, the very first thing that we should talk about when it comes to fundamental stock analysis is something that really has nothing to do directly with the numbers, but indirectly this will impact spending and debt and things like that, but that is the management. And that is because a ship is of no use without a good captain. So one factor you need to consider when analyzing a company is the management of that company, because ultimately what you're looking to determine is whether or not the company is being run well. Now, the best place to start is with the board of directors. And if you guys have heard this before, heard this term before, or maybe you've even been an investor in stocks and you've been sent around a voting proxy where you're voting on board of directors, that is why you're familiar with this, because these individuals are elected to represent the shareholders and create management policies as well as decide on major company decisions. And shareholders with voting rights elect the members. So again, this is another reason why voting rights are just so important to you guys. I mean, if you're going to be a long-term investor in a company, I hope that you are going to take the time to study the management and learn about the management. And then when it comes time to vote on the board of directors and different management employees, that you're actually going to take the time to learn about these people and make good decisions based on what you envision for the company. Because remember, guys, at the end of the day, you're part owner of that company, and you're going to want to make decisions or use your vote to allow the company to make the decisions on basically in their best interest, what you believe is in their best interest. So just like with local politics and elections, you want to learn about the politicians and the people that are running and decide who you feel is a best fit for the job. And I encourage you guys to do the same thing when you're looking at the voting proxies for board of directors and other management members of a company. But again, this is why I always invest in companies that allow you to have voting rights, or it's like one of my main things, because like we talked about Snapchat earlier on in this course, you basically, the co-founders have complete control over who's elected, and the shareholders have no voice. So now we're going to talk about the hierarchy of a corporation, and I just want to kind of give you guys an idea of what the food chain looks like. So at the very top, there you are right there. That would be you as a shareholder. So the shareholders are at the very top of the company, and below that, they essentially elect the board of directors, which are going to set management policies and essentially maintain best practices in the company. Now below that you have the president or the presidential level of the company, and then you have the treasurer and the secretary below the president, and then you have the vice presidents. Below that you have the managers, and then you have the employees. So understand that as a shareholder, you're at the very top of this hierarchy here for this company, for any company. As long as you have voting rights, you're going to be electing this board of directors, which is ultimately going to be controlling what else goes on in the company. They're going to be making these decisions and policies that the president and everyone else upholds to. So you are at the very top in terms of control, and everything essentially at this point trickles down. Now, what is the actual purpose of this hierarchy here? Well, the corporate hierarchy is designed to bring organization to what could otherwise be disorderly chaos. Now, think about the size of a company. Think about some of these large companies with tens, if not hundreds of thousands of employees. If everyone is not focused on a common goal, then you're going to have a lot of misdirection in that company. And corporations have large objectives that cannot be fulfilled by one individual. So instead, the organizational structure allows everything to be delegated. And the goal is to focus all efforts on the common goals and objectives. So really, the idea of this system is to keep everyone on the same page and try to keep organization when people in groups are working on such large projects and goals. So that's really the point of this structure, is to create some kind of organization out of what could otherwise be disorderly chaos. And this is why it's so important to consider the management, because the management and the board of directors are really the people that are orchestrating all of this, that are making sure people are working on common goals, and they're all aligned with the company vision and the company objectives. So this is why it is so important to really get to know and understand the management of a company. So as you can see, the board of directors plays a very large role in the corporate hierarchy. And one of the best places to start when studying the fundamentals of a company is with the management. So to be honest with you guys, and honestly, Warren Buffett agrees with this as well. If you want to, I think we talk about that a little bit later on, some of Warren Buffett's principles as far as fundamental stock analysis goes, but you might as well start with the management, because without good management, you really have no other point at looking at other figures, because essentially it's like that example of talking about a ship. You may have a great, strong ship, but with a lousy captain, it really doesn't matter. It's not going to get you where you need to go. So that is why one of the first things I study is the management of the company. And you're going to want to study the goals and objectives. And remember that the management is at the helm of the ship. And essentially, the best place to go to start this search is investor relations. And I'm going to give you guys an example of where to find this right now. So we're going to use Apple as our example of looking at the investor relations page. But if you're investing or you're considering an investment in a large publicly traded company, it is very likely that they're going to have an investor relations page. So the way to find this is you would just search the company name and then investor relations in Google. And so for Apple, I typed in Apple Investor Relations. And when I clicked on the link, this is the page that it brought me to. As you can see in the top left, this is Apple Investor Relations or Apple Investor News. And if you really want to bookmark this site and revisit it periodically, because while there are documents that they're required to file, they also may include news and updates about what's going on with the company that you would want to be involved with as an investor. So here we have an example of what type of information you'll find on the investor relations page. And I will tell you that Apple has a great investor relations site. So they provide a lot of good information. So here are 4 things you could look at here. On the top left, we have Apple and the environment. And this is, again, something that's very important to Warren Buffett when it comes to investing, is the responsibility of the company when it comes to their to the environment. And then you can see on the right there, they talk about their supplier responsibility. The bottom left, they have the newsroom, the latest news for journalists. And then at the bottom right there, the latest press, contact info, jobs, and more in the About Apple section. But what's most important to me is the executive profiles. And this is just the top 4 right there. This is the CEO, the Senior Vice President of Retail, and then the other 2 top management employees there. But what you can actually do is click on each one of these people and get a background about what their education is, what their experience is. And it's very important to understand, again, who is steering this ship, who is basically the one in control of all this. So one of the best ways to really study the management is to look at the investor relations page and look into the executive profiles of the management employees. Now, I know you're probably sitting here saying, this sounds time consuming. Well, it is. Nothing about fundamental stock analysis is easy. Nothing about fundamental stock analysis is quick. It's not something you sit down and 1 hour later you've analyzed a company and you go, okay, yep, I would like to invest in this company. Fundamental stock analysis, it's something that could take you days, it could take you weeks if you really wanted to dive in and go deep. And so few people are willing to do this, and that is why people oftentimes make bad long-term investments, because very few people are actually willing to do this. And many people would get frustrated if they were going through something and then all of a sudden something jumped out to them as a red flag and they said, nope, I better not invest. But the truth is, that would be a very good thing, because now you're realizing something you would not have ordinarily realized, because maybe something jumped out to you and you say, you know what, this doesn't really align with my core values as an investor, and as a result, I don't think I want to invest in this company. So it's very important to do this, and it's time consuming. It's going to take a lot of time, and really it can take as much time as you want, because you can keep going into more and more detail and learning more about all aspects of the business. So here's just another example of an investor relations page. This is Macerich, and I believe they are a commercial real estate holdings company. But this one has a little bit less information. They have the SEC filings, the supplemental information, and then the annual reports and proxy. Now we're going to touch on the annual reports later on, but this is a very important document to read. But again, this is one where they really do a good job of stuffing it with information. So if you're reading the annual report of a company, I wouldn't imagine, unless you really want to dive deep with it, I wouldn't imagine this is the kind of thing you'd read cover to cover. I think I've read the 2016 annual report for Macerich, and it was a little over 130 pages. So that I didn't read the whole thing. What you do is you kind of skim through it and pull out the important details that you're looking for, because most people, especially if you have a couple of different companies on your list, you may not have the time to comb through a 100-something page report. So really, you're going to get good at skimming and cherry picking out the good details that you need to look for, because unfortunately, at the end of the day, this really is a bit of a piece of marketing material for the company, and they're going to have a lot of fluff in there. So I want to briefly talk about Buffett's approach to fundamental stock analysis, because he has a number of core values when it comes to investing long-term in companies, but I wanted to share 6 of his that really align with me and ones that I agree with myself. So number 1, his biggest one, is the management truthful and straightforward with the shareholders? Now, while this seems like a quick answer, it seems like one you can answer very quickly, this is a very difficult question to answer, because it's not like you can just Google search, is Apple management truthful and straightforward with shareholders, and you're going to get an answer. This is the kind of thing where you have to really dig deep and do some research, and maybe you're looking for apologies of some kind or missteps. I mean, really what you want to look for is that the management is honest and straightforward, and they're not trying to sweep things under the rug. So that is basically, I would say that is Buffett's core value when it comes to fundamental stock analysis and investing long term. Number 2 is another one that I've talked about frequently on my channel and also in this course, and this comes right from Warren Buffett's approach. Is this a business I can understand and study? So if this isn't a business you can understand, if you can't wrap your head around the goods and services they're providing, then how are you ever going to analyze their documents and understand what healthy profit margins are and things like that? If you can't understand the business, how could you identify a good business versus a bad business, somebody doing the same thing that they're doing there, somebody conducting business in that way, or selling those specific goods and services? So really one of the most important things is that you are investing in businesses that you understand and businesses you can analyze and study. Number 3, is the operating history consistent? And this again comes down to what I've said before, is that every dog has his day. So you will see companies come into the limelight, but a lot of them lack consistency. And for a long-term investment, it's very important that they're able to operate at a very impressive level, but also consistently, because if it's not consistent, it's not worthy of a long-term investment. Number 4, does the company have a long-term competitive advantage? That's another important factor to consider. Are they a company that is the leader of their industry, or are they riding the coattails of somebody else? Number 5, is management treating shareholders fairly? So one example of this would be dividends or reinvestments of earnings. You want to make sure that management is paying back the shareholders and paying them through dividends or reinvestment of earnings and not so much being greedy and retaining profits for themselves. The sixth thing that you're going to want to look at in terms of what Buffett looks at is, and this comes back to the idea of looking for a company with a long-term competitive advantage, is that is the company a leader or a follower? So again, are they the leader of the industry? Are they at the cutting edge? Or are they following the other leaders and trying to keep up or trying to catch up, or simply just trying to pick up a couple of their scraps? So really, when you're investing long term, you want to be investing in the leaders. You want to be investing in the strongest links, not the weakest links of a chain. So the price of something is the amount of money expected, required, or given in payment for something. And in terms of investing, it is the price of a piece of ownership. Now, as we've talked about before, the fear and greed are really what change the prices on the stock market. And we're going to talk about this a lot more in the next module on the psychology of the stock market. But understand that supply and demand create fluctuations in the price. And volatility creates greater price fluctuations. So that is why when you look at maybe technology stocks or biotech stocks, you're going to see much greater volatility and greater price fluctuations. Now, let me ask you guys a question. Let's say you're looking at a particular stock, and you're looking at a technology stock, and next thing you know, that stock falls 5% that day. Did that company's value fall 5%? Did they lose 5% of their business, or did something drastically happen? The truth is, in most cases, no. So what happens is the price changes in the short term, but the value in the short term really does not change. It's only the price that changes based on the shareholders' perceived value of what that piece of ownership is worth. So while the price changes in the short term, the underlying or intrinsic value, which we're going to touch on later, changes only in the long term in most cases. So what you are, I'm sure this is something you guys are understanding now, but what you're doing as a value investor, and what I recommend doing, is really studying companies, studying the fundamentals, and understanding what the actual worth is, what the actual value is of this company. And then just looking at the price and saying, does this price make sense, or is this price too high? And then maybe at some point you do see a market pullback or a market correction, and all of a sudden that price makes sense, and you say, you know what, for what it's worth, I think this is worth it. So you have to understand that while the price changes very drastically in the short term, the value, the underlying value of that ownership does not change. So now on to value. So the value of something is the importance, worth, or usefulness of something. And in terms of investing, this is the estimated monetary worth of a piece of ownership. Now, the underlying value of this ownership does not change in the short term, as we discussed. It's only really the price that does. The perceived value of that ownership, or the price, changes based on the emotions of fear and greed. Now, successful investors know the value of the piece of ownership of a company, and they buy when the price is right. They buy when the price makes sense, when the perceived value is equal, if not below, the actual intrinsic value of that ownership. Okay, so we have another red alert to discuss here, and this pertains to things that you may see going on within a company, or things you may hear about that you want to watch out for. You want to watch out for insider buying or selling. And I don't want you guys to confuse this with insider trading. Insider trading is illegal. That is when you are trading with company information that is not available to the public. That is illegal. What I'm talking about is insider buying. And insider buying occurs when people employed by the company are purchasing shares of the company stock or selling shares. And particularly, you want to pay attention to management, or what members of management are doing. So if you saw management employees buying or selling large amounts of shares, pay attention. Pay attention to that. Because if management is buying shares and putting their money where their mouth is, this is a great sign that the stock has potential. Now, on the contrary, insider selling is a bad sign, because the truth is nobody understands the growth potential better than the management. So if you were to hear a management employee saying that their stock is worth a certain price, and then all of a sudden you see them buying shares today and the stock has been in a downtrend, that means that they really understand the value or the worth of their stock, and they understand the price is well below that value, and they're willing to put their money where their mouth is. It's one thing to talk. It's one thing to say, oh, our stock is undervalued. It's another thing to actually put your money where your mouth is. So I'm not talking about listening to what they're saying, and if a management employee is saying, oh, our stock is significantly undervalued, they are probably just saying that because it sounds good. But if they're actually buying shares, then you're going to want to pay very close attention to that, because that is usually a sign that there is some significant growth potential there. Now, this is not the same as a share buyback program. We're going to discuss that in Module 12 when we talk about corporate action, which is all the different things a company can do that can impact the share price. But I want you guys to pay attention to any kind of insider buying or selling. And then we have institutional buying, and this is, again, a little bit different. An institutional investor is a large organization, typically a mutual fund or a pension fund owner. And in order for your stock to appreciate, you need a healthy amount of demand. So you could be holding a great stock, you could find a great investment, but without demand, without people scooping up shares of that stock, the price is not going to appreciate. Now, institutional buying can significantly increase investor confidence and demand for the stock, because you have to remember, when an institutional investor moves into a position or picks up shares, they're buying a lot of shares because they own a fund and they're spending millions of dollars buying shares of that stock. So understand that institutional buyers, solely from the demand of them buying those shares alone, can significantly move the stock price. But on top of that, understand that many investors follow the actions of the institutional investors, because as we've said before, we have that herd mentality out there, and you have to remember that most people do not want to make decisions for themselves. They want everyone else to make the decisions for them, so as a result, they follow what these institutional investors are doing. So you will have people invest in these stocks solely for the reason that these institutional investors are buying the stock. So as a result, keep an eye out for institutional buying. Now, I'm not saying to use this as a buy signal, because if you do that, then you are simply following the herd. But what I am saying is, if you are invested in a stock and all of a sudden you see institutional buyers scooping up shares, that is a very good sign. So now we're going to touch on the Wall Street analysts. Now, as Buffett has said, Wall Street analysts are out there to make fortune tellers look good. So as a stock market master, you will not be investing based on analyst recommendations. So you're not going to open up Yahoo Finance and look at the latest buy and sell recommendations of analysts. You're going to make your own investing decisions, because you are not going to be a member of the herd. Now, these recommendations can, however, move the price of a stock. So I want you guys to, especially now that you're learning about all of this, invest based on your own research. But understand that analyst recommendations can motivate the herd to buy or sell. So understand that if you are holding a stock and all of a sudden some analyst comes out of left field and says, oh, everybody has to sell this stock, you're going to see the herd sell that stock. And it really shouldn't concern you, because you've done your due diligence and done your research. I just want you to understand that if a Wall Street analyst makes a buy or sell recommendation about your stock, it is going to move the stock price because of that herd mentality. So now we're on to value, and we're going to talk about the types of value. Now, there are a number of different values associated with an investment, and these are the market value, the book value, the intrinsic value, and the earnings value. And we will be discussing each of these going forward now. So first of all, we have the market value, and this is likely the one that you guys are most familiar with. Now, the market value of a stock is the price of a piece of ownership at a fixed point in time. Now, the quotation price of a stock represents the market value. So as I'm sure you guys can understand, the market value changes every couple of seconds. Now, this is due to the current market supply and demand, and market capitalization indicates the market value of a stock. Now, the market value is set by the supply and demand of the market, and the market value of a stock is really a poor indicator of whether or not something is a good investment. And investors out there that are not educated on value investing and fundamental stock analysis, they solely rely on the market value in making investment decisions. These types of investors out there, and these are the majority, they believe that the value is equal to the price, and the value is changing all the time. And I'm hoping by now you're beginning to realize that the underlying value really does not change, it's the price that changes. And the market value does not determine the underlying value of that piece of ownership. The market value is what people are willing to pay at a certain point in time based on the emotions of fear and greed. And then we have the book value. Now the book value of a stock looks at the assets minus the liabilities. So if you take the assets and subtract your liabilities, that leaves you with your net worth. Now the book value, on the other hand, looks at the assets minus the liabilities. So you would take the company assets minus total company liabilities, and this would tell you what the net worth is of that company. Now the book value provides the net worth of that piece of ownership, and book value does not account for intangible assets like patents and brand strength or goodwill. We're going to talk about that later on. So understand this only accounts for the physical, tangible assets of a company, and many companies, most of their value lies in the intangible assets. So this isn't always a great indicator, but this is a good thing to look at when you're trying to determine the underlying value of a company. So book value represents what a shareholder would get in theory if the company was liquidated, and book value is compared to the market value to determine if the stock is overvalued or undervalued. Now, the market value will always be higher than the book value in a healthy market, but the greater the difference between the book value and the market value, the more of a premium you are paying. But also keep in mind this may be largely due to the value of those intangible assets that are not being factored into the book value of that stock. So you may be asking yourself, how do you go about comparing the book value to the market value? The easiest way to analyze the difference between book value and market value is to look at the price to book ratio. So the way you calculate this, you take the market capitalization or the total market value divided by that book value, and this gives you the price to book ratio. Now this isn't something you have to calculate yourself. If you just Google search your company that you're looking at and you look for their price to book ratio, you'll be able to find these metrics yourself without having to calculate this. But I just think it's important to understand where these numbers are coming from. So a book value of 1 means the market value is equal to the book value, and you will likely never find a good investment with a price to book ratio of 1 or below. You're going to find them with typically, a much higher than 1, especially in a bull market. Now, the more overextended a bull market becomes, the higher the price to book ratio becomes. And this is really the difference between what the actual underlying value is of those tangible assets and what the market is willing to pay. So here we have two examples of this price to book value. We're looking at Procter & Gamble as well as Nvidia over the last 5 years, and as I'm sure you guys know, we have been in a bull market during this period. And if you guys are looking for a good site to get the price to book value, I recommend ycharts.com. It's a free service, and this is where I picked up these numbers. But as you can see, let's look at Procter & Gamble first. Back in 2013, they had a price to book value of 2.893, and as this market has become more overvalued and overextended, we're now looking at a price to book value of 4.388. So the actual market value has drifted further and further away from the book value of the shares. Now, Nvidia, on the other hand, the difference is even more drastic. It's more than tenfold. So back in 2013, we saw a price to book value or price to book ratio of 1.683. And then when I grabbed these numbers, we were looking at a 18.79. So more than tenfold what it was back in 2013. So people are paying a large premium for shares of Nvidia, significantly over what those underlying tangible assets are worth. Now, you do have to remember that a large amount of the value of Nvidia is those intangible assets, as well as what they have planned for the future. So that is why you're going to see such a large deviation between the price to book ratio today compared to 5 years ago. So the next value is the intrinsic value. Now, the intrinsic value of a stock includes the assets as well as the intangible assets. So the difference between the book value and the intrinsic value is that the intrinsic value is going to include these intangible assets, while the book value only includes tangible assets. Now, these intangible assets include the brand strength, the customer base, the patents, the proprietary technologies, the trademarks, the copyrights, the business processes, and more. And for many companies, this is where a lot of their value lies. Now, these intangible assets fall under what is called goodwill, and these intangible assets are valued based on perception because you can't really put a price on many of these things. You can ballpark it. You can have a rough idea of what the brand is worth or what the customer base is worth, but there's no set way to determine the price of these things, so largely that it is based on the perceived value. So as we said, these intangible assets are listed under goodwill, and you will find this on the balance sheet of a company. Now, goodwill represents the premium paid for a company for the intangible assets outside of the tangible assets. Now, the best way to explain goodwill is in terms of an acquisition. So, if one company acquired another, the price paid above the book value would represent the goodwill. Because remember, as we said, the book value represents the value of those tangible assets. So whatever premium is paid above the book value would represent the goodwill or the value of those intangible assets. So understand that goodwill is solely based on the subjective value because there's no set way to determine this. But certain companies would have more goodwill than others, and one of the best examples of this would be Coca-Cola. So Coca-Cola would have a lot of goodwill if a company was looking to acquire them solely just due to the brand strength and the brand recognition. I mean, think about how could you even begin to put a value on the Coca-Cola brand? It's so recognizable, and that alone would be worth billions of dollars, just the brand name alone. So that is the best way to think about goodwill, is what a company would pay above the book value if they were to acquire them. And then lastly, we have the earnings value. Now, equally important is the ability a company has to make money. And the value of the earnings potential of a company is known as the earnings value. So earnings value is the earnings potential of a company. And two common metrics are used to determine the earnings value of a company, and these are the two that I look at myself. Number one, we've touched on a little bit already, but we're going to go into a little bit more of an explanation of it. The first is the price to earnings ratio, and the second is the price to sales ratio. Now, both of them are a derivative of the market price or the market value of a stock. So first of all, we have the price to earnings ratio. The PE ratio weighs the current earnings value of a stock against the market value. So you would take the market value per share, you would divide that by the earnings per share, and that would give you the price to earnings ratio. And essentially the best way to think about this is the premium paid on $1 of company earnings. So if you were paying for a PE of 45, that would mean you are paying $45 for $1 of company earnings. A lot of people call this the earnings multiple. This allows you to determine if a stock is trading on an investment basis or a speculative basis. Now, as we said before, you use the PE ratio to compare the PE of one company to another within the same industry. It's not useful outside of industry, so you wouldn't compare the PE of a beverage company to a tech company. You would compare a beverage company to a beverage company because each industry has what is considered to be a normal or average PE ratio. So you're essentially going to benchmark the PE of the company you're looking at to the PE of the industry or the PE of the other companies within that industry or the market leaders. So I want to give you guys an example of what someone would consider to be a speculative price to earnings ratio. So if we look at the performance of this industry over the last year, as you can see, it has outperformed the S&P 500 quite significantly. So I grabbed these figures on 9/19/2017, but at that point the year-to-date return on the S&P 500 was 17.05%, while the year-to-date return from the aerospace and defense industry was 41.02%. So this has been a major outperformer, and I want to try to find an investment that somebody might say is trading at a speculative price to earnings. So the industry PE is a 23.43. So here we have a company that falls within that industry. This is Mercury Systems Inc. And as you can see, their current price to earnings ratio is an 84.19. So 3.6 times more expensive than the industry average. Somebody might look at this and say this is a nosebleed PE ratio. This is a sky-high speculative PE. Because as we said before, the industry PE was a 23.43 compared to an 84.19, which is a much higher price to earnings ratio. But now we have to stop and think about the trailing versus the forward PE, because this is really a great way to explain why a company might have such a high price to earnings ratio. Now, the trailing PE ratio is based off of existing data from the previous year of earnings, and the default PE ratio is that trailing PE. Now, the forward PE ratio is based on earnings expectations in the following year, and remember, the company may or may not live up to these expectations, But as you can see here, we looked at that same company. Their trailing PE is sky high at 83.26, but their forward PE is a 33.3, a much lower PE, but still significantly higher than the industry average. Maybe that PE makes a little bit more sense now. I still would think that is a little higher than what I would be comfortable with, but you can see that looking at the forward PE can really give you an idea of why the current or trailing PE ratio might be so high. But I want you guys to remember that the forward PE is based on expectations, and a company may or may not live up to these expectations. So you don't always want to take stock in the forward PE ratio of a company, because it's essentially as good as the analyst expectations of a stock. Their expectations at the end of the day. And as I'm sure you guys know, or you're going to learn, companies do not always live up to those expectations. So now we are on to the price to earnings to growth, or the PEG. Now the PEG ratio compares the PE ratio to the anticipated 5-year growth, and this is usually a good metric to use to kind of understand whether or not the current PE is justified. It basically helps investors determine the level of speculation involved with an investment. So the way you would calculate this is you would take the PE ratio divided by the earnings per share growth projected over the next 5 years, and this gives you the PEG, or the price to earnings to growth ratio. Now a PEG of 1 means the PE ratio is justified based on the anticipated growth, and a PEG below 1 means the stock is below the fair value, while a PEG above 1 means the stock is above the fair value. So if we look at the PEG of the stock from the previous example, we see a PEG of 3.17, which is quite high, but you do have to remember we are in a overextended bull market and looking at a breakout industry. So that is why you're seeing such a high PEG. But I highly recommend looking at the PEG ratio of a stock to get an idea of whether or not that PE ratio is justified. If you see a sky-high PE ratio, it's good to factor in the anticipated growth to get an idea of whether or not that PE makes sense, or maybe there is a high degree of speculation involved with that investment. So I know what we've covered so far with the PE and the PEG ratio might be a little confusing, so I want to give you guys a simple explanation of what I'm talking about here. So let's say I have an ice cream stand that nets a profit of $10,000 per year, and I'm trying to sell it for a list price of $1 million. So based on that figure, it would take 100 years to recoup your investment, and this ice cream stand has an earnings multiple, or a PE ratio, of 100, which is very high. So I'm trying to sell this thing to people, everyone's looking at it, I'm telling them what my net profit is, they're like, you're out of your mind. We're not paying you an earnings multiple of 100. However, this is a booming area, and I expect to net $25,000 in the next 12 months. I expect my earnings to grow significantly. So now this ice cream stand has a forward earnings multiple, or forward PE ratio, of 40, because I expect my sales and my revenue to increase significantly. So that is really the best way to show the difference between a forward PE and a trailing PE ratio. So while it does seem to be overvalued at a PE, or an earnings multiple of 100, once you consider the fact that I'm anticipating my earnings to increase significantly, now it has a forward PE of 40, which is a little bit more reasonable, but still probably too expensive for the average investor. But this is just a good example to explain what the PE ratio is and how something becomes overvalued, because let's be honest, most people out there would not pay $1 million for an ice cream stand that nets a profit of $10,000 per year. It's just not a good investment. But unfortunately, this is exactly what happens when people invest in overvalued companies. It would be just like investing in this ice cream stand here, where you're only turning a profit of $10,000 and you're valuing this ice cream stand at $1 million. That's what happens when the PE ratios get into a speculative level and people are paying way too much. They're just paying for value that really isn't there. So now we're on to the price to sales ratio. So the PSR weighs the current earnings value in terms of revenue against the market value. So you take the market value per share divided by the revenue per share, and this gives you the price to sales ratio. So revenue per share is not a common metric used, so you will likely use total sales and market capitalization. But again, this is something you can typically just Google to get a figure. You don't have to calculate these yourselves, but it's just good to know where these numbers come from for your own understanding of it. Remember that it is common for companies to operate at or near break even, so this can inflate the PE ratio as there are little or no earnings, and we're going to go over an example of this now. So we're going to consider Amazon. So as of September 19th, 2017, Amazon had a PE ratio of 245. So that means for every $245 invested, you are getting $1 of company earnings. So that seems to be very high and very speculative. However, Amazon is known to operate as close to break even as possible because they are spending as much money as they can expanding and growing the business. Then we look at the PSR. That gives us a better idea of why this PE ratio is so high. The PSR of Amazon was 3.16, meaning Amazon stock is priced at 3.16 times the annual revenue, which is far more reasonable than a PE ratio of 245. So the PSR ratio is very useful for investigating the nosebleed PE ratios of a company. And again, you can also use the PEG to get an idea of whether or not that PE ratio is justified. Now that we are in an era where we're seeing a lot of companies operating at or near break even, it really makes the PE ratio a difficult tool to use because it gives you numbers that really don't make sense or are not a good indication of the underlying value or the earnings value of that company, because these companies are not interested in turning a profit. They're interested in growing and investing as much money as possible back into the business. Okay, so now we're going to be revisiting the balance sheet, which we talked about earlier on in this course, but rather than analyzing your own balance sheet, which you should have done already, we're now going to talk about analyzing the balance sheet of a company, which is one of the most important documents to look at. And we're going to be talking about the three financial or the three income documents that you should analyze when it comes to fundamental stock analysis. The first one being the company balance sheet. So earlier we talked about the importance of creating and analyzing your personal balance sheet, and now we will be analyzing the balance sheet of a company. And as we said before, just as a brief recap, the balance sheet is a comparison of assets to liabilities. So if you subtract their total liabilities from their total assets, that gives you an idea of the net worth, or in your case, if you do this yourself, this gives you an idea of your personal net worth. So first of all, we have assets. So we will be looking at the items typically found under the assets section of a company balance sheet. So you have current assets and then non-current assets, and we're going to give some examples of these. But current assets are cash and other assets that are expected to be converted to cash within 1 year, while non-current assets are long-term assets that a company expects to hold longer than 1 year. So the difference between those is very simple. Current assets, they're going to be converted into cash, or they're currently cash, and that's going to be converted into cash within 1 year. And any non-current assets, these are long-term investments or assets the company holds that are not going to be converted into cash within that year. Now, the difference, it really comes down to, again, think about asset liquidity. Non-current assets are not as liquid, and they're not readily convertible into cash. These are not things that you can just go out and sell in an easy way. They're not readily convertible into cash. So here are some common examples of the current assets and the non-current assets you would have listed on a company balance sheet. So on the left, under current assets, cash and foreign currency, any highly liquid investments, any accounts receivable, or inventory. These are all things that are currently in cash or expected to be converted into cash within the next 12 months. And then under non-current assets, this is the property, this is the plant, the equipment, this is the goodwill, the intangible assets like the brand, any illiquid investments. A good example of this would be any acquisitions and other intangible assets. So obviously, if a company has property or an operating plant or equipment, this is not something they're planning on liquidating into cash in the next 12 months. So it's considered to be a long-term asset, or in this terminology, a non-current asset. So it's just good to understand the difference between these things. So when you're looking at the balance sheet, you understand what a current asset is and what a non-current asset is. And now we're going to look at the liabilities that you're going to find on the company balance sheet. So just like assets, there are both current and non-current liabilities. So current liabilities, if you haven't guessed yet, these are debts that are due to creditors within the next year. And non-current liabilities are long-term financial debts that are not due to creditors within the next year. So we're going to look at examples of both of these now. So on the left, the current liabilities that are due in the next 12 months, this would be short-term debt, This would be accounts payable, taxes and interest payable, any declared dividends. So dividends before payment are considered to be current liabilities, and then maturing long-term debt. So if there's any long-term debt that is coming to maturity, it transitions from non-current liabilities over to current liabilities because it is due within the 12-month period going forward. And then the non-current liabilities, the debt that is due further out into the future, this would be your long-term debt, your bonds payable if the company has issued corporate bonds, any pension liabilities, and then any deferred revenues, taxes, or liabilities. So again, when you're looking at the company balance sheet and you see current versus non-current liabilities, these are items you would expect to see under each of those. So what are you looking at when you're studying the balance sheet of a company? What are the major things you should look at? And if you guys are trying to wonder what you should be writing down, these are very important things to write down because I think this should be on your list of things that you're going to look for when analyzing a company balance sheet. These are the things I consider myself, and we're going to go over an example of this shortly. Number one, are total assets growing each year? Because you're going to want to see assets growing. Number two, are total liabilities growing each year? And three is very important as well. Are liabilities growing faster than assets? Because that would mean they are taking on more debt than they are taking on cash or things that could be easily converted into cash. Number four, is inventory growing or shrinking? You do not want to see a company sitting on too much inventory. Number five, does the company have enough cash to cover current liabilities? So one of the most important things you want to consider is whether or not the company has the ability to pay off the debt or the liabilities they currently have. And you're going to want to ideally have them be able to cover their debt solely with their current assets, not just their non-current assets. Number six, what type of assets does the company own? So are most of their assets current assets that are currently in cash or convertible to cash in the next 12 months? Or are most of their assets non-current assets that are not readily available in the form of cash? And number seven, is most of the debt short-term or long-term, or current liabilities versus non-current liabilities? These are the 7 questions I ask myself when looking at the assets and liabilities of the balance sheet of a company. And I highly encourage you guys to include some, if not all of these, in your analysis of a company balance sheet. So the next section of the balance sheet we will discuss is the stockholders' equity. Now, the stockholders' equity is the net worth, or what is left over when all liabilities are covered by the assets. So when you take the simple equation of assets minus liabilities equals net worth, well, net worth is also known as stockholders' equity. And a general rule of thumb is that stockholders' equity should always be growing. And if it is not, this may not be a financially healthy company to invest in. So look at the stockholders' equity over the last 5 to 10 years, and one thing that I always look for is consistent double-digit growth in stockholders' equity over a long period of time. Again, remember, it's very important to find consistency because you may see a company doing very well in the short term, but it's important for a long-term investment to see a good track record. Okay, so now we're going to take a look at the balance sheet of Google, and I will say they have one of the best balance sheets going, so they were a perfect example for this here. And Google is one of my long-term investments, and once you guys take a look at the balance sheet here, I think you'll understand why I see they have a very good, very healthy balance sheet, and they're very well run financially. So this is what a balance sheet is actually going to look like. And I kind of simplified this just for the slide here to fit everything on here. But this is from Morningstar. This was a Morningstar view of the balance sheet. So if you go on Morningstar's website and look for their balance sheets, you'd be able to find the balance sheet of most of the larger companies. But as you can see on the left, where those arrows are, if you click on those arrows, it will provide you more of a breakdown. But for everything we're doing here, I pretty much just needed the overview of the current assets versus the non-current assets, the current liabilities versus the non-current liabilities, and then the stockholders' equity. So as you can see, one of the first things I look for is, are total assets growing? And total assets are growing consistently, and it was a 15.7% year-over-year return on average, and what I look for is a double-digit return, so that checks that off on my box. Then we look for total liabilities to see if they are growing, and they are growing at a much slower rate. So total liabilities are growing at 5.76% year over year on average versus the 15.7% growth for the total assets. And then we look at stockholders' equity. Again, we want to see this growing at a double-digit rate, and over the last 5 years we're looking at here, there has been an 18.8% year-over-year growth of the stockholders' equity on average, which is fantastic. And then another important thing to consider was whether or not their current assets, which as you remember is what is currently held in cash or converted to cash in the next 12 months, covers their current liabilities. So looking at fiscal year 2016, they had a 6.3 to 1 coverage ratio of current assets to current liabilities, which is a great coverage. So you always want to make sure their current assets cover their current liabilities, and the greater that number is above 1, the better. So 6.3 to 1, that is fantastic coverage of the liabilities. And then when we look at their assets, we see most of their assets are current assets, which is good. And most of their debts are current debts as well, so they're not holding a lot of long-term debt. So this is an example of a fantastic balance sheet. This is one of the main reasons why I'm heavily invested long-term in Google, is because they just have a fantastic balance sheet. So this is what you are looking for, and this is an example of what it would be like to go through and analyze the assets and liabilities of a company balance sheet. So now we're going to take a look at a balance sheet that is not so good. This is Rite Aid. So first of all, the major red flag, if you look at stockholders' equity, back in 2013 and 2014, Rite Aid had negative stockholders' equity, which is something you never want to see. That means that their liabilities exceeded their assets. So then let's take a look at the current fiscal year here and get an idea of whether or not their current assets are covering their current liabilities. And as we said, Google's was well above 6. And when we look at Rite Aid, their coverage ratio is a 1.68, which is not a very good coverage ratio. So essentially their current assets are just above their current liabilities, and you want to see a coverage ratio above that figure there. I tend to want to see at least above a 2 to 1 ratio of coverage of current assets to current liabilities. So 1.68, not very good coverage. But then things get even worse when we look at total assets and total liabilities, not just the current ones, and their total assets barely cover total liabilities. So in the current fiscal year, they have a 1.05 to 1 coverage on total liabilities. And then when you look at the assets, you see most of their assets are non-current assets. So most of the assets they hold are not assets they're looking to convert into cash anytime soon, or they're not readily convertible into cash. What we have determined looking at this balance sheet is that Rite Aid is drowning in debt. They have way too many current and non-current liabilities, and they don't have healthy coverage of those liabilities. So this is not something you'd want to see on the balance sheet of a long-term investment. Now I want to take what we just looked at and explain this more simply. So let's take a look at this and pretend that this was the balance sheet of your own house. So let's say, for example, Google is your balance sheet, and the balance sheet of Google is the balance sheet of your own household. You would have $12,918 sitting in cash. So your stocks would be your current assets. You have $92,490 in investments that are easily convertible into cash. And then we're going to consider your home equity is your non-current assets. These are your long-term assets. So you have $62,089 built up in home equity. And then your credit card debt or your current liabilities is at $16,756. So first thing we notice is your cash just about covers what you have on your credit cards, but if you consider what your short-term investments are, that would easily cover your credit card debt. And your long-term debt or your non-current liabilities is at $11,705. That would be like the mortgage on your home. So all in all, once you figure all of your liabilities and your assets, you are sitting with a net worth of $139,036. So if Google was your own personal balance sheet, it would be a pretty good balance sheet. Now we'll take a look at Rite Aid. So if Rite Aid was your own personal balance sheet, you would have $245 in cash, and then your home equity, what you have built up in your house, or your non-current assets at $6,528. Then we see that your credit card debt or your current liabilities is at $3,000. So your cash does not come anywhere near covering your current liabilities. So you would need to sell off some of your short-term investments in order to cover what your credit card debt is. And then when you look at your mortgage or your long-term debt obligations or your long-term or non-current liabilities, that's at just under $8,000. So if you combine your cash and your current assets, it will not cover your long-term debt obligations. So once you do all the numbers on this, if you were Rite Aid, you would have a net worth of $614. Look at the drastic difference between these two balance sheets. Look at the fact that Rite Aid has $245 in cash, and that's over a third of their net worth is what they're holding in cash. That is not good when they have such a small amount of cash. Versus Google, where their net worth is more than 10 times what they're holding in cash. So this is a good way to see what a good balance sheet looks like and then a lousy balance sheet. And Rite Aid has a very lousy balance sheet because they don't have a lot of current assets and they just have way too much debt. They are drowning in debt. So this is what you want to look for in a balance sheet. You want to look for a balance sheet closer to Google than you would be looking for a balance sheet closer to what Rite Aid has here. So the next statement we will be analyzing is the income statement. Now, another important document to analyze is this income statement, and this document reports the revenues and expenses of a business as well as what areas they are coming from. So the income statement gives a detailed explanation behind the net income. And remember, as we said before, net income is your revenue minus your expenses. So this really paints a picture of where the revenue is coming from and where those expenses are coming from. Now, as far as the income statement goes, the revenue section is broken down into total revenue and then cost of revenue. And this is very easy to understand. Total revenue is the total sales of the goods and services the company offers, and the cost of revenue is what it costs the company to obtain those sales. So what we will remember here is that your gross profit is equal to your total revenue minus your cost of revenue. So all of the money you made on the sales of your goods and services minus what it actually cost you to obtain those sales is what's going to be known as your gross profit. So following our example looking at Google, we're going to analyze Google's income statement. So as you can see here, we have the last 3 years of Google's revenue, total revenue, cost of revenue, and then their gross profit, which makes up their income statement. So when looking at these statements, they can be broken down into annual and quarterly statements, and it's really a good idea to look at both of these, because as I said, you want to look at 5, if not 10 years of data, as well as the most recent 4 quarters to get an idea of the bigger picture, as well as what's been going on in the shorter term. So the biggest thing is you want to see total revenue increasing, preferably at a double-digit rate. Now, do remember that, as you can see on the top here, all numbers are in thousands, but I'm just going to read them as they are just for the sake of not confusing myself, to be honest with you. But looking at this here, we see total revenue for 2014 at $66 billion. We see total revenue for 2015 at just about $75 billion, and then for 2016 over $90 billion. So we are seeing consistent growth of total revenue. But what's equally important is their gross profit, because you could see growing total revenue, but if the cost of revenue is growing faster than the growth of the total revenue, you're not going to see these figures carrying true under gross profit. You'll see growing revenue, but what's very important as well, if not more important, is what their actual profit is on these numbers. So you want to see gross profit growing at a double-digit rate as well. Because if total revenue is growing and gross profit is not, you need to look at the cost of revenue, and it's possible that their cost of revenue is out of control. So total revenue for Google grew 13.6% from 2014 to 2015, and 20.3% from 2015 to 2016. So those are great numbers. And then we'll consider gross profit. We want to make sure that the cost of revenue is not too high. So gross profit after the cost of revenue is considered grew 16.1% from 2014 to 2015, and then 17.7% from 2015 to 2016. So these are fantastic numbers. That is excellent growth to be seeing. So increasing total revenue is resulting in an increase in gross profit, meaning the cost of revenue is reasonable. So these are numbers you're going to want to see. You're going to want to make sure total revenue converting into gross profit growth as well, because otherwise you need to make sure the cost of revenue is not outpacing the growth of total revenue. And as we can see with Google, we are seeing very healthy growth across all three categories of the income statement. Now, operating expenses are broken down into research and development, selling, general, and administration, and then non-recurring as well as other expenses. So R&D is the amount that the company is spending on research and development of new products or services, and then SG&A, or the selling, general, and administrative, are the expenses incurred from product or service promotion, sales, and delivery, as well as the company management expenses. And then a non-recurring expense is not expected to occur regularly. That is why it's labeled as non-recurring. And other expenses are the overhead expenses, which you may not even see listed because oftentimes they're tied in with the SG&A. Now again, like I said, you want to look at this annually as well as quarterly, but we're going to be looking at the annual numbers here. So first thing you want to look at is those non-recurring expenses. If you see any expenses listed under the non-recurring section of the income statement, it is a good idea to investigate these expenses and find out what these non-recurring expenses are. The biggest thing you want to see is rising operating expenses resulting in rising revenue. Because if operating expenses are rising while revenue is flat or falling, this is a sign of poor financial health. And as we already saw on the operating income, we are seeing healthy revenue. We are seeing healthy rising revenue. So that's a good indicator that the expenses are under control and they are reasonable. So operating income is the company earnings before interest and taxes. So at the bottom we see operating income or loss, and Google is currently not operating at a loss, as you can tell. So operating income is the company earnings before interest and taxes are paid, and operating income should be keeping pace with revenue growth. Now, as far as the research and development as well as the selling, general, and administrative expenses go, these you want to see growing at a similar rate as the revenue growth, and if there is ever a sudden increase in these expenses, this is again a good indicator that it's time to do some investigating and really uncover why it is those expenses are growing so rapidly. So then we have the income from continuing operations section of the income statement. So at the top we have total other income / expenses net. This represents interest income from cash and cash equivalents. And then this section of the income statement outlines the tax and interest expenses. So the net income from continuing operations, that's the figure at the bottom, this should be equal to the total net income, assuming there are no non-recurring events or expenses. So what exactly is a non-recurring event? The most common one is a discontinued operation, which results when a segment of the business is sold or abandoned, and at this point, this income is no longer a result of continuing operations. So that is considered to be a non-recurring event, and it can no longer be factored into the continuing operations section of the income statement. So that is why you would see a non-recurring event listed, as if some part of the business was sold or abandoned. So what are you looking for in the income statement? These are the 8 things that I look for, and again, this would be a good thing to write down so you can start building your list when you're analyzing these financial statements. Number 1, is the company increasing sales and revenue? Number 2, is gross profit keeping up with total revenue? Because remember, if your gross profit is increasing and your total revenue is flat, you need to consider what the operating expenses are. Number 3, are we seeing double-digit revenue growth? You want to make sure we're seeing double-digit consistent growth. Number 4, is the cost of revenue growth reasonable? Because if that cost of revenue growth is out of control, that may be eating into the gross profit, and then that may be why total revenue is not the same as the gross profit, the growth of the gross profit versus the growth of total revenue. Number 5, are there any non-recurring expenses? Because if you see a non-recurring expense, that is something you're going to want to investigate. Number 6, is an increase in revenue resulting in an increase in operating income? Because as revenue increases, you should see operating income increasing at a similar rate. Number 7, is the company maintaining profitability? And then number 8, are any of the expense items increasing at an abnormal rate based on prior years or quarters? You don't want to see any drastic fluctuations in these expense items. You want to see them consistently growing at a healthy rate over time. Okay, so the third financial statement to analyze is the cash flow statement. Now, the cash flow statement is another important document to analyze, and the 3 documents I study are the balance sheet, which we covered, the income statement we just talked about, and now we're going to talk about the cash flow statement. And later we are going to discuss the quarterly earnings report. And the quarterly earnings documents provides an update on all three of these financial statements. So it's going to update the balance sheet, the income statement, and the cash flow statement. So basically, once you understand these three documents, you will be able to interpret the quarterly earnings report. So we're basically building all three of these blocks, and you're going to be able to then just take a look at that quarterly earnings report and track the overall progress to get an idea of the financial health of that company and whether they're continuing on the same track. So this financial document shows how changes in the balance sheet have affected cash and cash equivalents. So essentially this illustrates the amount of cash and cash equivalents entering and leaving a company. This is the money going in and then the money going out. So your personal cash flow statement, which is again something you guys should look at, would be what you earn each month versus what you are spending each month. So that's the same thing we're doing, but just for a company this time. And this statement shows you where money is coming from and how much money is being spent. And essentially this is going to give you an idea of how the company is operating and if they have healthy cash management. Obviously, if the company is spending all of the money they're earning or spending more money than they're earning, think about what that would mean for your own life. If you were in a situation where you were spending what you were earning, you would be paycheck to paycheck. And if you were spending more than you were earning, you would be going into debt. So these are not things you want to be seeing from the cash flow statement of a company. So what separates the cash flow statement from the other income statements is that it does not include future operations on credit. The balance sheet and the income statement include both cash sales and sales made on credit, while the cash flow statement only includes the cash sales. So any sales made on credit that are going to be paid in the future are not included in this cash flow statement. So essentially cash enters and leaves a company through three different avenues, and those avenues are operations, investing, and financing. And these three avenues make up the cash flow statement of a company, so we're going to break down each of these three avenues now. First of all, we have operations. So a company generates cash from the products or services they offer, known as the operations. This is the goods and services they provide. The positive or negative cash flow of these operations is a result of the cash coming in and the cash going out related to these operations, related to the goods and services they are selling. Now, operations includes the cash, the accounts receivable, depreciation, inventory, and the accounts payable. Now, it's important to remember that not all transactions involve cash items. Oftentimes, they involve credit. So these are excluded from the cash flow statement. The only items listed on the cash flow statement are items that are involved in a cash transaction, not a credit transaction. And then we have the investing avenue. So this includes cash flow from investing activities. The investing section of the cash flow statement indicates any gains or losses as a result of company investments, and these could be capital assets like equipment or buildings, but this could also include investments in securities or business acquisitions. So if they're doing something with the cash they are holding, such as investing it to earn a rate of interest. However, typically under the investing section, these will be losses as a result of capital expenditures associated with these investments. So one of the biggest examples is depreciation of the equipment and the buildings that they own. And then we have the financing avenue of the cash flow statement. So this section includes any changes in debt, loans, or dividends. When capital is raised through the issuing of corporate bonds, for example, this is a cash inflow. And then when capital is spent through the payment of dividends to shareholders, for example, this would be considered a cash outflow. And both of these would be indicated under the financing section of the cash flow statement. So this is where you're going to find out how much is being borrowed and how much is being repaid under the financing section of the cash flow statement. So let's go ahead and take a look at the cash flow statement for Google, and the first avenue being the operating cash flow. So this is what it's actually going to look like on top. We're looking at the last 5 years and then the 5-year trend of the net operating cash flow for Google. And there's a lot that goes into this document. I don't really go that in depth with it. I look at two figures here. Those are the net operating cash flow growth and then the net operating cash flow to sales ratio. So under the operations section of the cash flow statement, the most important thing to analyze is the net operating cash flow. So what you're looking for is steady and consistent growth of net operating cash flow. This is very important, especially when double-digit growth is seen year after year. So as we can look at here with Google, For the last 5 years, we're seeing consistent double-digit growth of the net operating cash flow. So we see 12.128% and then 19.92% the year following, 16.3%, and then in 2016, almost 40% growth in net operating cash flow. And as you can see there, the 5-year trend is trending upwards. So this is fantastic. This is great numbers that you're going to be looking for as far as the net operating cash flow growth goes. Again, like we said, you want to see double-digit growth, and we are well into the double digits here, especially into 2014 and 2016. Now, the other thing I look at is the net operating cash flow to sales ratio, because this indicates the ability a company has to turn sales into cash. And the higher the percentage is, the better. Because what is the good of sales? What is the point of having good sales if those sales aren't being converted into cash? You want to see a healthy amount of cash being generated from the sales that they have going on. So again, what we're looking for with both of these here is consistency. You want to see consistency. So if the figures were to change out of nowhere, that would be a red flag. If all of a sudden they had a 30% operating cash flow to sales ratio and it fell to 10%, that means that the sales are not being converted into cash, and you need to analyze why that may be. So just to recap, what you're looking for here is double-digit growth in the net operating cash flow, and then you want to see a double-digit percentage when it comes to the cash flow as far as how it's being converted into sales, the net operating cash flow to sales ratio. So this is what I pay attention to under the operations section of the cash flow statement. And next we have the financing section of the cash flow statement, and I also included investing activities under the investing section of the cash flow statement because that's really the only thing I pay attention to under that section. The most important metric to look at under the financing section of the cash flow statement is the free cash flow. So what this is the net operating cash flow after the capital expenditures, which are outlined in the investing section of the cash flow statement. So that's what I look for under the investing section of the cash flow statement, is those capital expenditures. So if you take the net operating cash flow and subtract these capital expenditures, that is going to give you the figure known as the free cash flow, which is one of the most important figures to look at under the cash flow statement. And again, as I'm sure you guys have guessed, what we're looking for is steady and increasing free cash flow, and we are definitely seeing that with Google here. As you can see, in the last 3 years, their free cash flow has increased significantly. 41% from 2014 to 2015, and then 60% from 2015 to 2016. So they have excellent free cash flow, which is something you want to see. So just to recap, these are the things that we are looking for under the cash flow statement. Number 1, how much cash is entering and leaving. Number 2, are operations resulting in consistent growing positive cash flow. Number 3, are capital expenditures growing faster than cash flow from operations. Number 4, is the net operating cash flow to sales ratio showing double-digit growth. Number 5, is free cash flow growing at a consistent rate. And number 6, is the company a cash cow? And we can say with confidence at this point, after analyzing the 3 financial documents, that Google is a cash cow. And that is a great thing to see in a long-term investment, is a company that has a lot of cash. So really, this is the big picture. You're using these 3 financial documents to determine the financial health of the company, the debt versus the assets they own, and essentially how cash is entering and leaving. And this all shapes up to give you an idea of the financial health of a company. So now we're moving on to the quarterly earnings report. So this is something that public companies are required to file quarterly, and essentially they're reporting an update on their earnings performance and updating you on all 3 of these financial documents. So this report allows investors to determine the ongoing financial health of a company, and the main figures that people pay attention to are the earnings per share, the revenue, and then the company guidance if they are providing guidance. And we're going to discuss all of these shortly going forward here. Now, Wall Street analysts, and again, remember analysts, as we said, as Warren Buffett has said, they're out there to make fortune tellers look good. So as a stock market master, you're not going to be taking stock in what they are saying. You're not going to be taking their word on truth. You're going to be very skeptical of what they are saying. But nonetheless, Wall Street analysts are going to base buy and sell recommendations off of these quarterly earnings reports. And analysts also set expectations for these quarterly earnings And do remember that these are just expectations, and oftentimes they fall short or they come above those expectations based on company performance. Now, the report provides the public with an overview of sales, expenses, and net income for the previous quarter. So oftentimes this report also provides a comparison to the previous quarter as well as a year-over-year comparison, so you can get an idea of where the company is trending financially or what is happening, if things are trending upward, downward, or just moving laterally. Now, many reports also include a narrative from the CEO or some financial spokesperson for the company about what is seen in the report. And do remember that they're going to paint the best picture possible, so make sure you are going through that and taking what they're saying with a grain of salt, because their job is to, make things look really good, even if they may not be as good as they are. They're trying to paint the best picture possible. Now, companies also file a 10Q, which provides a more comprehensive report. However, this 10Q filing usually comes out a few days or a few weeks following the quarterly earnings report, so it's important to look at both of these documents. And you're going to be using the same strategies we discussed before to analyze the quarterly earnings report. You're going to look at the balance sheet, the income statement, and then the cash flow statements that are provided in this quarterly update by the company. So the first thing that people really pay attention to is the earnings per share figure, and this is the bread and butter of the earnings report. This indicates what the company earned per share in that quarter, and the earnings per share indicates the profitability of a company. Now, beating or falling under the EPS forecasting can send a stock soaring or tumbling. So when you hear about a company beating earnings expectations, it means they beat the EPS or the earnings per share expectations set by those Wall Street analysts. Now remember, it is in the best interest of an analyst to provide an accurate estimate, because if they're way off, frequently people are going to stop listening to them. They're not going to have as much credibility. So these analysts are going to do their best to provide the best estimates and forecasting possible. And then we have revenue, something that is equally important. Revenue is the income generated from the goods and services being sold, and like the earnings per share, Wall Street analysts set expectations for the revenue. Now, increasing revenue should result in an increase in the earnings per share, but do remember this is not always the case. And now that we've talked about looking at those financial documents, you guys will be able to dig deep and understand why revenue is not resulting in earnings per share growth. And then we have the guidance, and in my opinion, this is the most important part of an earnings report. Now, this is an indication or an estimate of the future earnings performance, and typically this includes revenue, earnings per share, margin, and estimates of ongoing capital expenditures. Now, guidance is not required, but reputable companies tend to provide these estimates. And company guidance figures tend to be far more accurate than analyst expectations, so I pay a lot of attention to the company guidance figures they provide. So what you want to look for is a company that is raising guidance. They have better expectations going forward for revenue and earnings per share and margin and other things they're providing guidance on. You want to definitely pay attention when a company that you're investing in is raising their guidance figures. So as we said before, these Wall Street analysts are out there to make fortune tellers look good, and this is a perfect example here. This is the last 4 reports for NVIDIA in terms of their earnings per share reported versus their consensus earnings per share forecast by these analysts. And on the right there we have the percent surprise, which is how far above they came to what the analysts were expecting. So in the most recent quarter, they had a 50% surprise. In the previous quarter, it was a 25%, the previous quarter, a 20%, and in the last reported quarter, they're 45.61% earnings surprise. So as you can see, these forecasts for earnings per share have not been accurate, and NVIDIA has been blowing them out of the water. And as a result, look at the performance of the stock over the last year. As you can see, it was somewhere above $50 a share, and now they are trading almost at $200 a share in 1 year. So that is rapid appreciation in the stock price, largely based on the fact that they are blowing expectations out of the water and consistently beating the consensus estimates of these Wall Street analysts. Now, when you're looking at the quarterly earnings reports of a company, you're going to see these figures listed in GAAP versus non-GAAP earnings. So when a company reports earnings, they provide GAAP and non-GAAP figures. And the generally accepted accounting principles, or what GAAP stands for, are set by the Financial Accounting and Standards Board. Now, this standardized the financial reporting procedure for ease of comparison. So companies are going to disclose the GAAP earnings, but they're also going to disclose their own accounting figures under the non-GAAP label. I know this gets a little confusing here, but what you guys are going to look for is a large discrepancy. So if you see a big difference between the GAAP and the non-GAAP reportings, then that is going to be a red flag, because there are some methods of creative accounting that can kind of fluff the numbers. And if you see a company reporting non-GAAP earnings per share that are significantly different, or non-GAAP revenue that is significantly higher than the GAAP, then you're going to want to pay close attention to that and do some investigation, because it may mean that they are using some creative accounting to fluff the numbers. So generally speaking, you want to see these figures be relatively close in value to each other. And all you're really looking for is discrepancies or deviation when looking at GAAP versus non-GAAP earnings. So the next financial document that you guys want to look for, and it's the one we looked at in the beginning under the investor relations, is the annual report. So if you are investing in a company long term, it is very important to read this annual report and take your time with it. Now, reports like this are not important for short-term investors, and they are useless to traders. You're not going to hear about a day trader reading through the annual report or the 10Q, because they only care about the technicals. They don't care about the fundamentals of a company. But you can typically find the annual report on the investor relations section of their site. And I provided an example here of how I navigated to the investor relations site for AMD. Again, you just type in AMD Investor Relations, and you're going to click on the link that directs you to the site for that. Now, again, I think this would be important for you guys to write down, but this is what I'm looking for when I'm looking through the annual report of a company. Number one, are earnings growing year over year? You want to see growing earnings. Number two, are sales also growing year over year? It's equally important to see sales growing, not just those earnings growing. And also pay attention if you see sales growth that is not resulting in earnings growth. That would be a red flag. Number three, does the company have a healthy balance sheet? And now that we've talked about the balance sheet, you should be able to identify what a healthy balance sheet is and what an unhealthy balance sheet is when a company is carrying too much debt or too much in liabilities. Number four, is the debt increasing or decreasing? And this again is something you will find on the balance sheet. Number five, this has to do with what the company is writing as far as their vision or their plan. What strategic plan has the management laid out? Because they should include in this a snapshot of what's going on within the industry and what their plan is to move forward and grow in the future. Number six ties in with this as well. What is the company vision going forward? And number seven, this ties in with what Warren Buffett says about whether or not management is honest with shareholders. Are there any carefully worded apologies involved in the annual report? Make sure if you see that you investigate, and if they're apologizing for any reason or carefully structuring an apology, this is a good indication of whether or not management is being honest with the shareholders, or if they're just trying to sweep things under the rug. So also included in this annual report is a letter from the board of directors. And one of the first things you will see when you're looking at this report is this letter. In most cases, any reputable company that provides this annual report, pretty much the first thing you're going to come across is a letter from the board of directors. Now, do remember that, like the narrative along with the quarterly earnings report from the CEO or the company spokesperson, these people are the master of the spin when it comes to the story. They're going to try to put a creative spin on anything they can and try to make bad news sound like good news. So understand that the letter from the board of directors and also the narrative from the CEO in that quarterly earnings report could have a biased perspective. And I always say treat the letter from the board of directors the same way you would treat a letter from a politician. Go through it with a fine-tooth comb and take things with a grain of salt. So when I read this letter to the shareholders, these are the 6 questions I ask myself, and I hope to answer these questions by analyzing this letter. Number 1, is the industry undergoing any changes or disruptions? And hopefully, if management is being honest with shareholders, they're going to point these out in that letter. Number 2, what actions are planned to overcome these challenges? So if there are challenges that they are identifying, what is their plan to overcome these challenges? So you want to make sure they're not just identifying them, but they're also talking about what they're actually going to do to overcome these challenges. Number 3, what details are being highlighted? And number 4, what details are being brushed over? Because oftentimes, Think about a good magician. They're going to be drawing your attention elsewhere when the important thing going on is happening behind the scenes. They don't want you paying attention to that. So understand that what they're drawing your attention to may be a way to draw your attention away from something else. So you want to pay attention mostly to what they're actually brushing over. What may not be, maybe what's not being explained in as great of detail might be something you actually want to pay the most attention to, because like we said, they may be putting a creative spin on bad news. Number 5, are there any changes in management? Because if there are, you're going to want to go back to square one and study the new management executives entering the picture. And then number 6, have there been any new acquisitions or major company breakthroughs? You're going to want to pay particular attention to those. Now, most annual reports will also include a section that outlines the goods and services they provide, and there's no set format for an annual report, so I can't say what this is going to be called, but as you're reading through it, eventually you're going to come across a section where they're discussing the goods and the services they provide. So part of the annual report is outlining the goods and services the company offers, and this comes down to understanding the business you're investing in. It is very important to understand what a company is generating revenue from, and it is equally important to understand where the revenue is being generated. So in order to really do this, in order to understand these things, you need to understand the business. This is why it is so crucial to invest in companies and invest in a business you fully understand. Because if you don't understand the business, it's going to be hard for you to determine what a company is generating revenue from, where the revenue is being generated as far as the location, and whether or not this is a healthy area they're generating revenue from, and whether or not these are numbers that you want to be seeing. So you want to also consider what markets they are serving, any kind of geopolitical concerns involved with those markets. So maybe they're serving third world countries and there's a lot of political unrest in those areas. That might be a red flag. And based on the goods and services they're providing, also identify the competitors serving the same customer base. So I'm hoping at this point you guys really understand the importance of fully understanding the companies and the businesses that you invest in, because otherwise it's going to be damn near impossible to go through this and try to understand things like where they're generating revenue from, how they're generating revenue, and whether or not these are healthy revenue streams going forward. Okay, so I know we've covered a lot in this section, and I'm hoping you're not overwhelmed. If you are, like I said, just go through this a couple of times, or even just go through one section at a time and really get a good understanding of it. But I just want to give you guys a recap. So if you were going to analyze the fundamentals of a company, these are the things I would do in this order. Number 1, the first thing I would do, I would visit the investor relations site and I would learn about the management. Because as we said, a ship is only as good as the captain. Number 2, read through the vision or the outlook report. Oftentimes, aside from that annual report, you'll see companies providing documentation on the vision of the company and the goals and objectives. Number 3, you're going to study the balance sheet. 4, you're going to analyze the income statement. And 5, you're going to review the cash flow statement. Once you've done this, you've looked at maybe the last 5, if not 10 years of data. Now you're going to update yourself every quarter and read the quarterly earnings report to get an idea of whether or not they are still trending in the same direction and maintaining good financial health. Then after that, once the 10Q is released after the earnings report, you're going to go through the 10Q and uncover more details. And then every year when they release the annual report, you're going to really bury your nose in that annual report, look at the letter to the shareholders, look at the goods and services, and analyze this document and look at the things we've mentioned already. But this is the big picture here of fundamental stock analysis and my procedure of doing this anyway. So the last thing we're going to talk about in this section are factors that give a company value outside of the numbers. And the first thing we're going to talk about is brand. So one of the most important fundamental strengths of a company that I look for myself is a strong brand. Now, a brand, in my opinion, and many people agree, is one of the most important parts of any company. And companies, trends, and brands, as you guys know, they come and go. You know, some companies are hot for a little while, some trends are hot and then they just disappear. And you want to make sure you're investing in a durable company with a very strong brand and a company that's not going to be phased out, a company that is not a trend. So a strong brand conveys quality, it conveys integrity, credibility, and an experience the customer has come to expect. So that's what you want to look for in a strong brand. You want to look for a quality brand, a trusted brand that people really feel good about. So I want to give you guys an example of what a brand can truly be worth, and this is a perfect example of the goodwill we were talking about, of when a company acquires another company, the dollar amount paid above the book value represents the goodwill or the value of those intangible assets. So in 2010, Kraft acquired the Cadbury Confectionery Company for $19.5 billion. Now, the value was not necessarily in the factories or the recipes. I'm sure if Kraft wanted to, they could open up their own factories to make chocolates and candies, and they could come up with their own recipes that would be pretty good. But the value was the strong and recognizable brand. The value was in the Cadbury brand because when people buy Cadbury chocolates, they've come to expect a certain level of quality. They've come to expect a certain experience, and that is why Kraft was interested in acquiring Cadbury, was for the name. It was for the brand. It was not necessarily for the actual tangible assets. The value was in those intangible assets, and this is why it is so important to invest in a company with a strong and reputable brand, because there's a lot of value being carried in that brand. So I want to do a comparison here for you guys because I think it's interesting. When you look at these two companies here, I want to ask you guys, and actually enter a comment below. I know you guys can comment on these modules. So leave me a comment below. Which brand gives you the expectations of quality, integrity, and credibility? Is it LL Bean or is it the Champion clothing? Because I know when I think about quality, when I think about durability and just a good experience, I'm leaning towards LL Bean. When I'm thinking about discount gym clothing, I think about Champion. That's just what I think of when I think of these brands. And I want you guys either answer me in the comments below or answer me in the Facebook group. What are some of your favorite brands? What are some of your favorite companies? I'm not even talking about on an investing standpoint. As a consumer, what are your favorite brands? What's your favorite restaurants? What's your favorite food companies? Your favorite clothing companies? Because a lot of people have the same favorites because of the strength of the brand and the experience you have come to expect. And this is a very important factor to consider when analyzing the fundamental strength of a company, is the strength of that brand. So what is so interesting about a brand is that the value and reputation of a brand is something that is built over decades, and that reputation can be destroyed in hours. So I have two very good examples of this. First of all, as I'm sure you guys remember, United Airlines, they yanked that passenger off in a violent manner. It spread like wildfire in the news, and now this really tarnished United Airlines brand. These may not even be things people think about. It may be something they think about subconsciously when you're going to pick a flight, when you're ready to fly. Are you going to choose Southwest? Are you going to choose United Airlines? You might lean away from United Airlines without even realizing it, just because you're subconsciously thinking about that negative event that happened with United Airlines. This is what happens. People really need to realize how much the reputation matters when it comes to a brand, because these are decisions people are making oftentimes on a subconscious level. And another example of this is with Chipotle. So over 2 years ago, they had the E. coli scare where 53 customers ended up sick. And here's an article that was released on September 13th of 2017. Over 2 years later, people are still avoiding Chipotle. And again, do you think this is because people are still worried about getting E. coli? Probably not. It's just a subconscious decision they're making when they're trying to decide where to eat. They just have a negative taste in their mouth or a negative association with Chipotle because this tarnished their brand. This is the importance of a brand, and this just goes to show you guys how easily a brand reputation can be destroyed even from one simple event. So one of my cardinal rules of investing is to invest in a company with a strong and reputable brand. And before you invest in a company, even after analyzing the financial documents, consider the brand reputation. So even if everything looks perfect, even if the numbers are great, all the financial documents are good, they have a ton of cash, they're a cash cow, they have low debt, you're seeing increasing revenue, the management is great, think about the brand. Consider the brand, because the reputation of a brand can make or break a company. And as a rule of thumb, I always benchmark a brand to Coca-Cola. So ask yourself this question: how strong is their brand in relation to arguably one of the strongest and most recognizable brands out there? So if you had a scale from 1 to 10, 10 being the strongest brand out there, 10 is Coca-Cola, where does your brand fall as far as the reputation, as far as how recognizable it is? And that's one of the last things I think about, is the strength of the brand and whether or not this is a brand people are happy when they think about, or a brand that they associate with a negative recent event. And this is something that a lot of people don't think about, but it's so important because these are subconscious decisions people are making. Like Chipotle, for example. People are not going to Chipotle because 53 people got sick 2 years ago. Nobody thinks about E. coli anymore, but you just have a negative association in your mind due to an event that tarnished the reputation of that brand. So the final factor I consider in fundamental stock analysis is the barriers to entry involved with the particular business. So these are the high startup costs or other obstacles that prevent new competitors from entering an industry. So you want to always look for high barriers to entry, otherwise there is always a risk that your company will be phased out by a competitor. Now these are 6 common barriers to entry, and you guys may have more that you add to your list, but these are 6 common ones out there that you want to consider when you're analyzing a company fundamentals. So sit down and get an idea in your head of, if somebody were to start a brand new version of your company, would these barriers make it difficult for them to edge in and steal away their customer base? Number 1, government regulations. Are there government regulations involved with the goods or services they are providing? Number 2, what are the startup costs? How expensive would it be to start this business? Number 3, the technology and the research and development. Is there a lot of R&D and technology involved in what they're doing? Number 4, the patents. Do they have legal protection to do what it is that they are doing? Or could somebody just go in and replicate their business and they would have no legal leg to stand on? Number 5, the supplier and distribution channels. So when I think of that, I think about Amazon. Think about the size of their fulfillment network and how difficult it would be to compete with Amazon. And number 6, again, this ties with the brand, the customer loyalty. How loyal are the customers to that brand? Because these 6 barriers to entry can really protect a business and make it difficult for others to enter that segment and disrupt that business.